Hello everyone and welcome back. So in this section we are going to look at the chart of accounts. So without wasting time, let's dive right into it. So here let's look at the chart of accounts here. So I'm just gonna click on that. Okay, that's fine. So now we have got the chart of accounts. Okay, right. So the chart of accounts basically it shows us all the important accounts that we need to work with in order for us to properly track our revenue, our expenses, our assets, our liabilities. Okay, so these pertain to the income statement. So we have got accounts that pertain only to the income statement and to the balance sheet. So all these they will now flow through the cash flow statement. Okay, so for example, we have got the name for each account, account type, we've got the detail type, we've got QuickBooks balance, we've got balance, and then action. Okay, so here you can connect a bank account, you can edit, you can make it inactive, you can run a report on a particular account. So cash and cash equivalents, this is cash, right? And you find it, this is the cash balance for the firm, you find it in the balance sheet, okay, under current assets. This is the most liquid, right? And sometimes it includes investments in money market securities, right? And here we have got allowance for bad debt. Okay, so in allowance for bad debt, we are just saying this is just a provision, right? Like in business, not all customers will pay back their debt. Okay, like there are some customers who come to buy from you on credit or on account, and those customers, due to some pressures in their businesses or economic challenges, they may fail to pay back. So as a business, you need to come up with a provision, a certain percentage, even 2% of your total accounts receivables as an allowance for bad debt. So bad debt, we are saying this is whereby a customer default on paying their balances to you or to your business. Okay, so we have got available short-term available for sale assets. So these are assets that you are holding in your business that are not inventory. Sometimes you have got furniture, right, that you might want to sell at a discount, and that may be classified under short-term or current assets. Or sometimes this could be securities that you are looking forward to sell in the short term. So those can also be classified under short-term current assets. These are highly liquid. So as you can see, these are current assets. Okay, these are balance sheet items. Then we have got so the allowance for bad debt is charged in the profit and loss, right, as an expense. And in fact, the increase is an expense and the decrease is treated as income. Then that same allowance for bad debt reduces the balance of accounts receivables in the balance sheet. And then we've got the inventory. Okay, so inventory, these are stock items that you buy from your suppliers for the purpose of reselling. Okay, so these are key or crucial to the operating performance of a business. Okay, because obviously you need inventory. Then we've got the inventory asset. Okay, it's also the same as inventory. Then we've got prepaid expenses. So prepaid expenses, this is an account because in your business you may have electricity, rentals, water, and all sorts of expenses. So sometimes you can pay in advance for items that you need. Let's say you can pay in advance for electricity, or you can pay in advance for your rent or stationery. Okay, So that is treated as a current asset because the supplier is owing you. So it's still your money, even though you haven't exhausted the services from the supplier. So this is a prepaid expense. And then we've got an categorized asset, and this one you can just add a certain asset that you may want under current assets because it's not categorized. There is nothing as uncategorized asset, so you have to specify which current asset. Then we've got accumulated depreciation on property, plant, and equipment. So what happens is you buy an asset in your business, let's say a delivery vehicle. So that delivery vehicle maybe is supposed to last for 5 years. So you have to account for the wear and tear on that vehicle. So as you are using your vehicle every day, its value is being eroded, or it's depreciating on each and every day use. So obviously you have to charge depreciation per year or per month, okay, because monthly depreciation will also be aggregated to be part of a yearly depreciation. So you charge depreciation per year in the income statement, or per month in the income statement, and then that depreciation that you've charged in the income statement, it also has to reduce the value of that asset in the balance sheet. And mind you, depreciation is the cost, is the accounting for the aging of assets, and is a non-cash item, okay? So it's just an allowance to you for using these assets in your business. Then we've got the property, plant, and equipment. These are the assets that you use in your business. And here you see we've got fixed assets, we've got detail type. This could be land, okay? So property, plant, and equipment. So this could include the property, that the buildings that you're using, they depreciate in value. We've got the plant, production plants. We may have equipment such as motor vehicles and all. So all of that form part of this property, plant, and equipment, right? And then we've got assets held for sale. These are non-current assets, which are fixed assets. For example, we may have like motor vehicles that you want to sell, right? That are, that you have used maybe for far too long, and you want to sell them, and then you are holding them to just sell them. Then we've got deferred tax assets. Okay, so deferred tax assets, they reduce the tax liability. Okay, let's say at some point you may have overpaid for tax, and it results also is due to the varying methods of depreciation that you may be using. So it reduces the tax liability that you have to pay in the income statement. And then we have got goodwill. So goodwill is an intangible, and it falls under non-current assets. This could be, and mostly it arises as a result of acquisition. So if you buy a certain business, then goodwill will arise, and you have to add it in your books. Then we've got some intangible assets like trademarks, trade names, copyright, things like that. You can account them using the intangible asset. Then we've got long-term investments like buying securities of companies that are publicly traded on the Zimbabwe Stock Exchange or the Victoria Falls Stock Exchange. You can also add them here, or maybe investment in property. Okay, investment property, you can also put it there. And other financial securities like treasury bills, something like that, but not treasury bills per se, because treasury bills normally fall under current assets. Then we've got accrued liabilities. So accrued liabilities, this is the opposite of prepaid expenses, right? Sort of like here we are saying there are some obligations that you haven't paid, right? Let's say for rent might be due, let's say for 2 months, and it has to be in accrued liabilities or even accrued salaries. And then we've got dividends payable, right? So this is where you can add dividends payable, dividend that might be due, that you haven't paid. And then we've got income tax payable. Okay, income tax payable, this is income tax due. Like, at some point you may have not been paying taxes, and those will be due, so you need to add them under in this account, which is income tax payable. And then we've got payroll clearing, something that is to do with payroll. So it just depends how you decide to account for your liabilities. Like, for example, in some organizations they may include that in accrued liabilities. They may include payroll, like expenses or salaries, something like that, which are accrued, which are due. Then we've got short-term debit. I'm not sure. Okay, short-term debit could be like short-term debt. Yeah, sort of. So short-term debt, obviously, all businesses are funded by either equity or debt. So you may, at some point, you may need to raise short-term debt to fund your working capital. So you have to add it, and you use this to account for that. And then we've got accrued holiday payable. This depends with organizations. Then accrued nanny, current liabilities. Yeah, it happens sometimes that maybe you have got some lease liabilities that you haven't paid for some time, and that could be accrued, sort of non-current liabilities related to assets out for sale. And then we've got long-term debt. You may choose to raise a long-term debt to fund your maybe capital expenditure, like buying more property, plant or equipment. Dividend disbursed, it falls under owner's equity, right? So it shows dividends that you have in disbursed to your shareholders, equity in earnings of subsidiaries. Let's say your company has got some stake in some small companies, which we call your subsidiaries. You have to account it in here. And then we've got opening balance of equity. This is the opening balance of the amount that you have invested as the owner, or as shareholders, or from investors. You also have to use this. Other comprehensive income, we've got retained earnings. So it will come into this, right? So for example, you have got net income. Okay, net income starts the cash flow statement, and net income affects the retained earnings. So this is how the flows will be like. And then we've got share capital. Okay, so opening balance, equity, share capital, it could mean the same thing, just in different setups or different companies. I am not sure how you treat that, but that could mean that, let's say, share capital, that also could include the money that you've raised, equity funding, and you have to account it using this. Then billable expense income, revenue general. This is the revenue account. Now this affects the income statement. Sales retail, sales also. So sometimes you have got sales whereby you're accounting for some items that you're selling to individual customers and items that you're selling to companies at wholesale price. Then we've got sales of product income, right? So you are selling products, and then you may use this one to account for that. Then we've got services. So this is, you use this revenue account when you are income account when you are offering some services. Then we've got cost of sales. These are for supplies and materials, freight and delivery. If you're offering delivery charges, you also might use this one. You also have to account freight and delivery charges using this account. Then amortization expense. This could mean that depreciation. Okay, because normally it's depreciation and amortization expense. So amortization, you're just amortizing tangible assets. And then bad debts, those are an expense because they reduce your revenue. And then we've got bank charges if you're using the bank in Zimbabwe, Obviously, they charge you bank charges and they are an expense to the business, commissions and fees. Let's say you've got some sales reps that bring you business, and obviously you pay them. So you pay them a certain fee as commission, then you have to use this account. Then dues and subscriptions. You have got Wi-Fi subscriptions and all that. You can use this to account for that. Equipment rental, if you're renting some stuff, to perform in your business, then obviously you have to use this account. And income tax expense, obviously you use this account to account for the income tax that you pay. And insurance, general, insurance liability, and interest expense. This is when you pay interest on debt that you have borrowed. And then legal and professional fees. This when you are involved in a legal battle and you hire some legal professionals, you have to account for the money that you pay them using this account. Loss on discontinued operations, management compensation. If you are paying a director fees and all that, you have to use this one. Meals and or management fees, and then meals and entertainment, you use this one. Office expenses like office in general, and other general and administrative expenses, obviously you have to use this one. Other selling expenses, obviously. And then payroll expenses, you can use this one to account for that. Purchases, you can use this account as well, same as cost of sales, still okay. Then rent or lease expenses. So if you're paying rentals, you have to account for that expense using this account. Repairs and maintenance on your property, plant and equipment, you can also use this account. Then shipping and delivery expense, stationery and printing, supplies, you can use this one. And then travel expenses, this could be transport, okay? Travel expenses, selling expenses, that is if you're catering for the cost for your sales reps who are going around advertising your product. Utilities like electricity. Then wage expenses, you can use this one if you're paying weekly wages. Then dividend income, let's say you are getting some dividends from your security investments or equity investments. Then for interest income, if you're investing in fixed income debt securities. Loss on disposal of assets, if you are selling an asset and you determine that you've sold it at a loss, you use this one. Then other operating income, and then unrealized loss on securities net of tax. So basically this is the basic chart of accounts. Okay, so like I want to go to the amortization expense. Let's say here like you can edit that. For example, here you can just open it up or try to edit that. So it opens this page here where you can do the edits. So let's see how it goes. So let's say you are free to add any account that you may want to use, right? Like for example, we have got amortization expense. This account is an expense, okay? Expense like this, account type. And then detail type, this is amortization expense, okay? So you can even choose here which ones you want, and even on the account type you can choose, like it's saying just expenses, and you can add, let's say depreciation, okay? You can add depreciation, then it would go under fixed assets. Like here you can say account type, they may affect your accounting. Are you sure you want to do this? So obviously for now you can leave it as is. Okay, that's perfect. So I think this is all about the chart of accounts. So you need to understand the chart of accounts in the event that you want to add some expenses, you want to add some accounts, make sure you know the relationships. And yeah, basically that's it. And that's cool. And so see you in the next section, where we are going to cover how to customize your invoice, all documents that you're going to send out to your suppliers or your customers. So thank you for watching.